Hi, I'm Mal from the Money Study, bringing you another episode of our Take 10 Challenge. And this is number 85, all about Lenders Mortgage Insurance, or LMI. There's my disclaimer, all about facts, figures, information only. This is not advice. Now, Lenders Mortgage Insurance, what's it all about? Effectively, what it comes down to is that banks, generally speaking, when you're going to get a loan for a house, they like to see 20% deposit. So if you're buying $1 million house, in theory, you'd need $200,000 deposit. If you're buying a $500,000 unit, you'd need to have a $100,000 deposit. Now, of course, 20%, $100,000 even, is a lot of money to try and save for a deposit. And generally speaking, people struggle to be able to get that 20% deposit. So effectively what it means is that banks will lend you money with a smaller deposit, providing you take out Lenders Mortgage Insurance. And the idea of the insurance is it's going to protect the bank. Now, it's an insurance policy that you pay the premium, so you're the person paying the premium, but in essence, you do not get the benefit. This is, I suppose the only other insurance like that is death benefit, where you die and you don't get the benefit. But every other insurance, in theory, you're paying a premium so that you are actually get your money back, or get something pays you for replacement of something. But LMI, Lenders Mortgage Insurance, what it's doing is protecting the bank. So let's imagine that you've got a property, $500,000 you're going to purchase, and you do not have a $100,000 deposit. You might only have $50,000 deposit. And so the bank says, okay, we'll lend it to you, but we want you to take this mortgage insurance out. So if anything should happen and you can't afford to keep on doing this, and we sell the house, we have to sell the house to get our money back, that we're not going to lose out. Meaning that they want to ensure that if you buy a house for 500 and then when you renege on the loan, you walk away, they try and sell the house and they can only sell it for 400, or let's imagine they sell it for 300, they're underwater, meaning that they don't get as much money back as the money they lent you. So effectively they protect themselves. They protect themselves using this insurance. You pay the premium. If you do decide they need to make a claim, if the bank needs to make a claim on this, the bank gets paid the money to them. But this is where it gets nasty, is that if that's the case, the lender mortgage insurance actually pays the bank, the lender's mortgage insurance company can come back to you to ask them to pay the difference. Now, to me, that's sort of what the hell are we paying a premium for, if we're also up for the difference anyway? But it means the bank gets their money guaranteed. Obviously, the mortgage insurance company might have a lot more difficulty. Obviously, if you can't afford to pay your mortgage, you're in pretty dire straits. You might have gone bankrupt, but that's in theory. So you could still be up for the liability, even though you've been paying these premiums. So now, is it something we try and avoid? Yep, it is, because this thing can be quite expensive, and I'll show you some examples in a minute. However, there's always however with these things. However, there are times where taking out lender's mortgage insurance is probably quite a smart idea. Because if it means that, yes, we've got to pay 1, 2, 3, 4% or whatever of our loan in mortgage insurance premiums, but the house prices are going up by 5, 6, 7, 8, 9, 10% or even higher, we could be chasing a moving target. So you're saving your deposit, you nearly got your 20%, but then house prices go up by another 10, and you think, so you've got to keep on saving to get that deposit up. So you keep on saving, you're just about to have enough 20% deposit, and house prices have gone up again. And you just keep on chasing this moving target of house prices. And because the house price has been going up at such a rate, you would have been better off, a couple of years ago to indeed, yes, pay the mortgage insurance because you're into the house and then of course the house has gone up in value since you've bought it. So there are times where mortgage insurance does indeed make sense. You can get in with a smaller deposit, get that loan, and of course when interest rates were low, on your mortgage and house prices were going through the roof, gosh, who cares about lender's mortgage insurance? In fact, you can get in with a 5% deposit, pay low interest rates on the debt, and then see your house price go up dramatically. So under that sort of scenario, it makes sense to use it. However, when it's the other way around, it's when your interest rates are getting higher and higher and house prices start to stagnate in going up, then ideally we try and save our money. So let's have a look at some of these values we've got here. Now, of course, remembering that I've just taken a snapshot from one particular company, and they would vary, and I must admit I can't remember how long ago I did this slide. It was probably a year or so ago, so they've probably changed again. But this is just to give you a bit of a ballpark as to variations between the size of the loans and the size of the equity. We talk about this thing called on the left-hand side there, LVR. This is your loan to value ratio. What is the size of your loan, compared to the value of the house? So when we talk about an 80% loan, then we've got a 20% deposit. So that's what we're looking at there. So you can see that if you look at this chart on the top left-hand corner, if you've almost got your 20%, you've got 19% deposit, so you just need this tiny bit of lender's mortgage insurance, and you're taking out, say, a $300,000 loan, then you can see there that you're paying 0.475%, just about 0.5% of your loan is going out to your mortgage insurance. Same sort of loan value ratio, but you're borrowing $750,000. It's not the same percentage. The percentage goes up because of the higher risk to the bank, and you're paying nearly 1%, 0.913 there in the top right-hand corner. So if you've got $1 million loan, you get to pay 0.9% there in mortgage insurance. But of course, things get worse, obviously, if our loan to value ratio decreases. You can see at the bottom of the page there, by the time you're getting up to 89%, then we're up to about 1.3% on a $300,000 loan, but up to 2.4% is what we're creeping up to there on a $750,000 to $1 million loan. And of course, if we keep on going up, yes, banks will lend you. There are banks that will lend you just with a 10% deposit. Some banks will lend you on a 5% deposit. Not all banks will do this. So don't expect that your bank will indeed let you have just with a 5% deposit, but there's quite a few that will. But I say they will certainly not lend you money with a 5% deposit without lender's mortgage insurance. But you can see the numbers there. By the time if you only got a 5% deposit and you've got to pay 2.609% on a $300,000 debt, but 4.6 on $1 million. 4.6 on $1 million. Yeah, do the numbers on that as to what that's a one-off premium. So this is not an annual premium. This is just a one-off premium. But that's a lot of money. That's dead money that's just gone. Now, banks will actually lend you the money, including the borrowings for the lender's mortgage insurance. So now you're paying interest on top of the mortgage insurance itself. So this is where you really got to do your numbers. Banks will be, fall over themselves, generally speaking, and lend you money, but can you afford it? And what is it really, really costing you to do so? So, it can work, can be useful at the right time, but please understand what you're getting into with mortgage insurance. If there are ways to avoid it, and we will talk about ways to avoid mortgage insurance over time in the next some upcoming episodes. But if we can avoid it, all well and good. But 4.6% on $1 million. Ouch, ouch. Happy to talk about it, and obviously a good mortgage broker could guide you through it as well.